Okay, so how did you do? Let's check it out. Here's what I've got, and some of these are fairly close. It doesn't matter. You get the idea that you're dealing with your parents and your brothers and sisters or cousins, and then their friends. They have an association with you. Neighbors have a little less. Your other friends, see, relative friends, they're pretty tight. And church associates. The problem with church associates, and this has to do with Muslims and Baptists and LDS and whatever religion it is, you've really got one major thing in common, and some con men like to use that thing in common to try to get you to invest or something else. You gotta be very careful of that. Certainly business partners have less points of contact, but they do have a very good one. Current customers are fantastic. Inactives are still good because they know who you are. But one of the worst things is taking an ad out in the Wall Street Journal because nobody knows who you are, or the Business Daily or anything else. If you've heard of the concept of 6 degrees of separation, or the Kevin Bacon effect, the idea that the Kevin Bacon effect is Kevin Bacon has worked with actors who worked with Clark Gable, who worked with somebody else who worked with Lillian Gish, who was one of the first silent screen actors. So in 6 degrees, 6 steps, you've covered the entire movie industry. And so Kevin Bacon could easily find out all kinds of people and know the associations. And that's great. But you can do the same thing. And what's interesting is the 6 degrees of separation because of the internet has dropped to 5. And the idea is that you want to find somebody in Peabody, Massachusetts, who owns a particular kind of computer. And so you can go out to your associates and see if anybody here knows anybody who lives in Massachusetts, and then go to those people and find anybody that lives in Peabody as they say, and then find that person and say, do you know anybody who works in the computer industry here? Yes, I do. There's a place that sells it to it. And you know somebody that bought this kind of computer recently? Probably they do. So in 6 steps, you can know just about anybody in the world. It's kind of frightening in some ways. But that should tell you, in using the law of concentric circles, that's where you're going to go to find money. You're not going to find money in the Wall Street Journal or by sending out advertisements to people who invest because they don't know who you are. One of the best things is going to people who you know and say, I've got this great product, I'm looking for investors, I know you don't want to invest, that's fine, but I wonder if I could show it to you, what we're doing, and see if you know somebody who might be interested in something like this, or they might know somebody. Okay. Right away, you are launching yourself onto one of the best ways of finding money. Okay? One of the things we need to do is make sure you never expect more out of people than what they're capable of giving you. So know what to expect from each type of investor. Now, I divided them into 3 kinds of investments. One is adventure funding. What this means is, I know lots of people that have $1 million, $2 million, $5 million, $10 million under advisement from an investment advisor. Well, within that, they have municipal bonds and other kinds of investments that are very safe. They also only pay 2 or 3%, maybe 4%, sometimes a little higher. And so then they want to have another basket of investments. So let's say they go to the blue chip stocks and they invest in Ford, they invest in Facebook or any other kinds of things that are listed on the New York Stock Exchange. Now those might have a 7 or 8% dividend, and that's getting to be okay, but it's not great. So then they have another basket of investments that they do that are a little more high risk, maybe they're penny stocks. All the way down at the end, they have something called adventure funding. This is mad money. This is saying, okay, I'm going to invest, let's say, 3%, 5% of my portfolio in highly risky ventures, and these are my cousin's business. There's an old joke, if you want to become a millionaire, start with $2 million and invest in your son's business, and you become a millionaire. So that's adventure funding. It's a segment of the portfolio, and it has a reason for it. It's valid, and I know a number of people in that part of it, it outproduces everything else they do because they become very good at it. Many real estate investments are someplace in between. Sometimes some real estate investments are close to being very, very low risk and high reward. So you just have to know what you're doing. Second thing is venture funding, and this comes from people who are in the business of raising money. Angel investors and VC groups. We'll talk a little bit about these, but basically an angel investor tends to be a singular person or a person who participates with a group of other singular people. They may invest together, or they may just sit down and talk about it and point it out and say, well, that sounds really good. You invest in that one, I'm going to invest in this one, and let's see how we do. And so they teach each other, and it's a very, very good camaraderie and a very good way for angels to be able to find out. We'll talk about more of that in a second. VC groups, venture capital groups, are groups that are companies. These tend to be fairly large companies with a lot of money under management, and we'll talk about those in a second. The third way is collateral funding. Collateral is when you put something up, like your house, as a guarantee for this investment, and if the investment fails, they take your house. That's collateral. You probably own a car, and you probably had to borrow against it. Well, the car is the collateral, which is why most of the times they don't give you 100% of the money of the value of the car. Okay, let's go to third principle. We'll come back to some of this in just a minute. I'm very concerned at this university and other universities I had where they demean, ridicule some kinds of investors. And I'm saying right now is you need to have a great affection and admiration and reverence for people who are willing to put up their money. You've got to consider it a sacred trust. So you've got to be able to respect everybody who's willing to do that, no matter who. Let's go to the traditional categories. Friends, family. This is where a great many businesses are going to get the initial capital for trying out an idea. There's some dangers there, and we'll discuss those in a second. But nevertheless, this can be good. It could also be that it's friends where you're talking in family and saying, who do you know? And so they're helping you. Be very respectful with them. But this is what they call the 3 F's, friends, family, and fools. And I just despise that characterization. You're going to talk to people you think are fools? There's something really wrong about that and denigrating. And friends of fools, oh, that's right, they're the 4 F's. Friends, family, fools, and friends of fools. And then they have doctors and dentists, who I know I've heard professors say this, doctors and dentists are called dumb and dumber. Because they have lots of money and they're really educated in something else, and they'll just put the money out and figure because they're educated in this, no problem at all. That may or may not be true, but I think it's a terrible way to begin. You should have respect and admiration for every one of these people. So we're going to say no to using that kind of language, and you won't see me do it. So we're respecting all potential investors. Let's talk about these friends and family. We've mentioned that in the law of concentric circle, you're going to meet people. This is myself in a group of people who all got together. They were all friends of each other, and I went up and presented to them. And there's always a danger in that, because you might get somebody who is having a bad day, or they just like to be a contrarian, and it puts the whole group off and it kills everything else. But I found it, if you have a group of friends, they're getting together because they're interested. They're excited about the idea that the friend has told them, so they're getting together. And I've usually had a very good experience working with groups like that. Another group, this particular group, is a group of financial advisors, very bright people, and they got all their financial advisors together, and we sat down and went through the numbers, and they got very excited, and they invest. So these I would consider to be very much friends and family in that category. And the next part is their friends and these affinity groups. Now, remember when I was talking about these guys? They're all financial advisors, so they have an affinity for each other. They're in a professional association, so they're willing to get together, and they're used to doing these kinds of things. Those are excellent business associates. Now there's the professional investors. We've already mentioned angel investors. This is with our team meeting up with some angel investors in groups. And finally, the venture capital company. Now, I'm going to show you a chart in just a second where we can see what each one of them requires in the whole thing. Let's do it right now. Typically with friendly, those are remember the people, the friends and family, they want no part of managing the company. They're saying, no, you take it. And one of the reasons they're doing is they trust you. They say, you'll be a good manager. They don't want board control. And the owner, because their ownership is going to be minority, and that's typically the way the friendly ones are. The angels, possibly they're going to want to manage the company or get involved in some management aspect. Most angel investors I know of are quite bright, and they have been successful in other businesses. And so they provide, one of the really great things is when somebody can provide their money and expertise. And that's a very powerful duo. Now, you obviously don't want them messing around in your everyday work, trying to get something done, and they're second guessing you. They don't want to do that. But they do want to be there for the big decisions. Board control, that possibly depend on how much they're going to put in. They're really, for the most part, in fact, one or two, but I've seen them where they wanted a majority ownership. They were satisfied with a minority ownership. Now, a really important part of understanding this is majority ownership in an LLC is retained by the management, because specifically in the LLC agreement, which you're going to be creating one. I'm giving you a template of it, and you're going to be able to finish creating it. Specifies that management runs the company. The managers run the company. And members, that's what these people would be, have no vote. So it might be that they're going to specify when they invest money in you that they will become a type of manager. I've had it so that one, they call it a team. Two people came in and says, we want to be part of the team. So whenever it calls for a team vote, that's those two guys and then the four managers. Now, it only had to do with decisions when we're going to purchase something for $5,000 or more, we were going to sell the company, or other kinds of large decisions. That's when they were going to be consulted. The last one, the venture capital, they usually want management. There's a story told of, I think it was Staples, that Mitt Romney and his Bain Capital were involved in, and they went in and they took over the management. They got a majority ownership, and people were saying, well, that was terrible. They took the guys out of business. No, the management wanted to be taken out because they knew they had taken the company as far as they could take it, and they needed somebody with larger circulation base, larger access to other markets, more money, and so they sold a majority ownership of that, and they came out sweet, because as a minority shareholder, they were making more than when they were the majority shareholder. So that's what a venture capital company will usually do. They want board control and a majority ownership. So just know that when you're getting into working with them. Okay. As I mentioned before, I never like to sell when I'm talking to investors. We're going to educate, we're going to guide them, we're going to give them these informational pieces all the way through, and that's what we're going to do as people presenting the investment. At the end of the time, when we've done all of these things, we can simply ask one simple question. How does this work for you? What's your comfort level in investing? That's it. And then they can make whatever decision they want, and guess what our answer is going to be? That's fine. I'm not going to call you up, and I'm not going to chase you down. You tell me if you want to do it now. If not, that's okay. If you ever want to do it, let me know. Now, they don't believe you, because they've been hounded by many people, but you're never going to chase the bid, we call it. You never chase the bid. Okay. We need to qualify every one of these investors before we sit down. I told you at the beginning of this, I've met a lot of people who think they know what they're doing and want to tell you they have all kinds of money and all kinds of influence, and they don't. So check people out. Find out what their qualifications really are. The other thing is you always ask them if they are an accredited investor. Now, we're going to show you in just a second exactly what an accredited investor is, but I'll just jump the cart just a little bit here. It's somebody that has a net worth of more than $1 million, not counting their house, or they've had $200,000 to $250,000 of income per year for the last 4 or 5 years. Why the or? Well, because the SEC changes rules, and there are different requirements. You have to check those out finally and to make sure. Whoever it is, you've got to insist they understand your investment is a high risk. I find almost everybody who ever raises money, when they first started raising money, cannot get those words out of their throat. It's a high risk. You know, it's like, oh, I'm giving, yes you are, you're giving the secret away. Because as soon as you do, you suddenly, as I tell all the students, I don't want you in jail. And if you have informed and taught and educated an investor, and you've told them of the risk, if they were to sue you and you go before the judge and you point out all the things you've done, and the judge will just look at them and going, they told you the risk, so case dismissed, generally. Okay. Education takes time. You guys are all in the education business right now, learning. It takes time. And when you sit down with an investor, as we were here, and you're showing them, you've got to make sure they spend the time listening to your whole spiel. You can't have somebody say, yeah, I got 5 minutes, tell me about it. No. I need at least a half an hour of your time to be able to go through. It's a high-risk venture. I want to make sure you understand everything there is to know about this. So that's what you're going to do. Now let's go back to accredited investors. As you can see, you have to be very blunt when you ask people this. Are you an accredited investor? And now if they say they're an accredited investor, I sometimes like to follow up and say, by that what I mean is, so you don't insult their intelligence, say, I may not state this correctly, so I want to make sure I do state it. Here's the 200,000, here's the other information. You want to find out if they're a trust, if they're a firm. Some people like to get together as an LLC, an investment group. You need to know what that is, and if they do, somebody needs to be an accredited investor in there. I've heard some advisors say, well, it doesn't matter. I think it does. I always want to know that somebody is responsible. And they say, well, you know, you can trust us, we'll take care of ourselves. No, you won't. Things go wrong. Now, when you look at this, we haven't talked about this yet. What do you do if your partner says, my mom's got a lot of money, we can get 20,000 from her? What do you say?
I wanna know.
Yeah, is your mother an accredited investor? Well, no, but she's okay with it. I'm not. Will your mom sue you? Probably not, but who might sue you? Maybe one of your brothers or sisters, when you have taken mom's last $20,000 and they want to get it back and help mom out, they may sue you. So we want to stay away from all non-accredited investors. Let me just mention, there are some other people besides who are non-accredited investors who are allowed to work with. And that's what they call people who should know better. Those are lawyers, financial advisors, bankers. So just imagine if they stood before a judge and the judge says, you lost money in them? Yes, they tricked me. Aren't you a financial advisor? Aren't you supposed to know that kind of stuff? Yeah, case dismissed. You're a lawyer, you're supposed to know that kind of stuff. Case dismissed. Banker, you see what I'm saying? It has to be somebody who is a friend of the court, somebody who should know better. And then you should still ask them, are you an accredited investor? And then they say, no, I'm going to waive that because I'm an attorney. That's great, not a problem at all. Okay? As I mentioned, as they wish. I've already mentioned this. This is what you want to always do, is make them comfortable and make it easy to say no. Now that just goes against our salesmanship. We always get them to say yes, get them to say yes, get them to say yes. No, make it easy to say no. So does that work for you? And how does it really? Okay, that's fine. End of conversation. I'm not going to even, I might in a regular negotiation say, well, what would work out well for you? I'm not going to say that. If they say no, that's great. Easy to say no. And they're only going to invest the money, and I sometimes ask them, okay, you want to put up $100,000, high risk. If you lost all this money, would you lose sleep? And they said, well, I wouldn't like it, and it might bother me for 10 minutes. Well, I'll get over it. That's what they have to be, because most startup businesses are high risk. And of course, once they have some money and good management, they can make it lower and lower risk as they go. Another point is get people to start small if they wish. I had an investor one time who's looked through the whole thing. I says, how does this look to you? It looks really good. I love the whole concept. I said, okay, what do you feel comfortable with? Well, what's the least amount of money I can invest? And we always had it that we wanted to have people put at least 50,000 in or more. So I said, we generally have people putting in $50,000 or more, and in $50,000 increments. But what would you feel comfortable investing? They said, well, I really only want to do 20,000. Guess what my answer was? Absolutely. Because the person was an accredited investor, so that's fine. So the person was going to put in 20,000. He then had a whole lot more questions. After half an hour of asking all these questions, I say, great, when do you want to proceed? He goes, right now. He wrote out a check for $100,000. So, and by the way, in a couple of years, as the company was progressing, he put in a couple $100,000 more. Starting off small, as they wish, don't chase the bid. Got that idea? Okay. Here is something that most students have a great deal of difficulty with. They're used to bluffing their way through. Oh, sure, I read the assignment. Yeah, right. But you've got to know your products. And what's our defense for knowing the product and knowing the numbers perfectly? The pro forma. Getting your pro forma, and then you're going to be able to not have to bluff. So you're thorough. Here's the thing, we don't tell them everything all at once. Because you gotta start off with a foundation, and then you gotta build up to and lead. There is a progression of information. We don't just shoot out all the information, so, and this is where the marketing frankly takes over, is you try to think, how am I gonna communicate with somebody? As you start communicating on the points that get their interest, and then keep building on it. I think that's something you all know, but make sure you do that. We'll get to it. So give them the idea of the headline first. What's the purpose of a headline? Is to get them to read the first line. What's the purpose of the first line? To get them to read the second line, and so forth. And so we're gonna generate our rhetoric in such a way as it's comprehensible and it's exciting. We're gonna build. I can tell them everything at once. Don't make it personal. This isn't about you. It's a, you know, this is business, this is goals and things. Stick to those. If they say no, it's okay. And if you take the attitude I've been using all the way through, if they say no, we're still friends, it doesn't matter, and I'm not gonna bring it up again. Keep it that way. Because it may turn out they invest and the business goes south, and you want the same thing in return. They probably will be a little displeased with you, but they'll be so pleased with the way you've treated them all the way through. The landing will be much softer with that. In the class, we're going to go through elevator pitches, power decks, all the full financial worksheets, everything else we're talked about here. We will be going through those in class, probably in another video session. We're gonna go through the business plan, you're gonna create one. It's not gonna be very long, but it's going to be pointed, have enough information to make the sale. How long should a business plan be? Just long enough to make the sale and not one word more. You know, don't oversell with that. I'm gonna introduce you to a PPM, and we'll tell you what it means in the operating agreement. I mentioned that, credit investor form. So, I've mentioned these are the, adventure funders. Let's talk about some of these. Equity. You're going to be dealing with a particular kind of company that you're gonna set up. Most small businesses are best served by creating an LLC. And we're talking about an active small business that's moving along, not something you think is just gonna sit dormant for 10 years, and the IRS consider that a hobby. C Corp is generally for something that you're going to want to take public. LLC won't go public, it can be, but that's a whole other discussion. S Corp and LLC, we're gonna discuss in another time, but they both allow the individual owners to own 100% of the company, and the money passes through directly to the owners. And there's some advantages to it. There's also a distinct advantage to getting people to invest in an LLC. That is, they're now a member. And so let's say they put in $100,000, they own 10% of the company. When the company loses, let's say they lose $1 million the first year. Well, they own 10% of it, they get a $100,000 write-off. And investors kind of like that. Even though they lost money, it's helping with their other tax events. And depending on your CPA, then everybody has a little different situation, but that's just a general idea. So this is the private placement, what we call, with this PPM was a private placement memorandum you're gonna put in with these people. Now, seed investing, there are various rounds, and you're gonna hear people talk about various rounds of investing. And they throw those words around like everybody knows what they mean. I've been in enough meetings where some people will say, well, we do an A round. And somebody said, well, that's not what an A round is. Well, that's how we call it, as an A round. And so you see these people, everybody feels like I'm the dummy. Gee, they use a seed round. I don't know what a seed round is. I'll have to listen. So what should you do? What's a seed round? What do you mean by a seed round? I've heard seed round from. Tell me what you defining as the seed round. Tell me what you're defining as the A round. You got to be able to do that. You cannot act as if you're foolish, because there's a lot of other people feeling the same way. And when you come to investments, you can't have ambiguity. You've got to know everything. So don't worry about it. Going the public path, just know up front, is a huge problem. It's very expensive. It takes a lot of time. And once you are public, you are governed in a whole different way that you probably won't like. You've loved your company, and you've been able to free flow and try this out and try that out, and you go public and you got handcuffs on as you're working it. Now, there's some huge financial advantages if you're big enough and can afford it at the time. But for the most part, let's put that off. There are penny stocks, which you can get into those, and reverse mergers. I'm not going to go into those too much, but you probably ought to look at them. Reverse mergers, I know some people that have made a lot of money at them, and I have a good friend who's in jail because of them. So I won't go into it too much, lest we give just enough information to get you excited to go into it, not enough to get you educated, and then you go to jail. We don't want to do that. Let's talk about debt. Many of your LLCs, once you start having some success, you have some assets, they will be able to go and get loans. And that loans can be wonderful because now you're not giving up equity, you pay the money back right away, and that's the end of it. One of a really interesting way is hard money loans, and we'll discuss those more in class. But hard money loans have a high interest rate, and they also have an extremely large amount of points up front, money up front. A point is like a percentage, but it isn't an active percentage, it's a dormant percentage. So if you're getting a loan for $100,000 and they say 10 points, well, that's $10,000, each point being one. So that's $10,000. You pay it up front, and then you get all the money, and you go about and you pay a 10, 12, 20% interest rate. But there's some business deals. I know one that just happened about a year ago up in Park City for a piece of property. It was valued at almost $7 million, the piece of property. And the people wanted to get out of it and were asking for $3 million. And they had $2 million at their disposal, and they needed another $1 million. And they knew they could turn around and get the financing and everything they needed, but they needed 6 months of money. So they got $1 million investment at, 10 points and about 22% interest rate. And they do it as fast as they could, because the people that were loaning the money, the property was the security. Remember we talked about collateral? That was the security into the whole thing. So at the end of 6 months, they paid it back, and they had a $3 million piece of property, a $7 million piece of property for $3 million, or $3,200,000, something like that, and they turned the whole thing and sold it for $10 million. Was it worth it? Of course. So there's some things you can do. There's government loans and grants, and various people at various times said there's all kinds of free government money. And no, there's not. There's very, very little of things like that. It takes a long time, and generally you have to be a large corporation in order to get grants. And yes, it does happen. More likely there's some local things like university has a contest or something. That's all great in there. The other one is Credit Card Circle. I'm telling you about it because people do it. I don't advise it. When we lived in Ohio, we were there for a short time, and we were renting a really nice place on Mansion Drive. And one day we get a panic call from the owner who lived down the street and said, "Where's my mail?" "Well, it's been sitting here, we've been gone," or something. He said, "This is gonna mess me up." He had bought the house using his credit cards. And you know how every once in a while the credit cards come in 3 months, they'll say, "We'll give you 3 months at no interest, you pay 2% down or 3% down." Well, he was using those one after another, and he was rolling one into the other and everything else. Well, we broke the circle. So he was panicking that he was gonna get hit really hard. He was lucky. So there's other ways of doing it. I don't recommend that one. There's creative ways of doing it. One way is to, I love creative bootstrapping. I think anytime you can go ahead and figure out ways to do it, that's great. We can talk about more of these if you have questions. One thing is to sell somebody an option where they want to invest in your company, but not yet. Maybe they'll put 100,000 in, but then you'll sell them for $1,000 the right to buy stock at the existing price 6 months from now. So that's an option to buy. You can do things like that. The other thing is there are companies out there that will guarantee your business. They're guarantee companies. And you have to buy the guarantee, and it costs a little bit of money, and they're willing to step in if you fail and finish the project. That's a really good way to raise money from other investors if they know there's a guarantee. Okay, we're getting in deep, but that's okay. Let me give you some bootstrapping ideas. We had a company that was, we were doing some work for a nonprofit. They didn't have any money. And one of the things we saw, the price of silver was starting to go up rapidly. And the people who knew this group, they all loved buying gold and silver and that kind of stuff. So I said, why don't we create a 1 ounce silver coin, pure silver coin, 0.999 fine, and they can buy it for, let's say it was worth $20, and they can buy it for $50, but the rest of it goes to the nonprofit organization. And we tested, people loved that idea. But they didn't have enough money to go make the die used in order to stamp out the coin. So what we did is we went out to all of the people who had ever donated to them before, and we had a drawing of the proposed coin and said, here's how the prices are, order it now, and allow 6 weeks for delivery. So the money came pouring in. We took all the money and we put it in a box in a drawer. Now, we didn't spend any of it, but we kept track of it. So we knew we had enough money to easily go out and fulfill the orders. Then we told the guy who had the mint, told him what we had done. He says, okay, I'll do it I won't require any money up front. But when he finished with it and we had the coins all ready to send out, then we cashed our checks, not before. You never cash the checks before the goods are sent out. But once we sent them out, we cashed the checks. The nonprofit made a lot of money on it. The guy with the mint made money, customers were happy. So that's pre-sell products. If you think about it, there's an entire industry based on that. And we're going to talk about them in just a second, but it's Indiegogo and Quick Start, Kickstarter, those kinds of things. That's what they're doing, is they're pre-selling products, but they don't get to get the money until after it's fulfilled. Many times, just like that mint, I was able to go to talk to them honestly, tell them what our situation was, and they were able to give us credit, which allowed us to leverage. You can go to existing customers that you have, and let's say that you're dealing with printing supplies, ink, and it's saying, we need some extra money right now. We're willing to sell you a 10-year supply of ink that would normally be $1,000, we'll sell it to you for $500. But you have to pay the $500 now and trust us that, we'll deliver all the rest. That can work. Just being careful with expenses works well. The era of a big office, it's generally a waste of time now. Sometimes it is. If you're partners in a business, everybody donates a certain amount of money, they're gonna get paid, and they wanna get paid $10,000, but they're gonna live on $4,000. So they're donating their time to it, that's how you do. The other thing is grow slower. Don't try to grow that fast, and just let it come, and it'll work. Crowdfunding is what I just mentioned. There's 2,900 possibilities of crowdfunding, and they're all based upon generally the same idea. You can look them up, there's lots of them. It's either reward, debt, or equity. And reward is what we just talked about, is you go to Kickstarter and you're going to give them $100, and for this, they're gonna have the right to buy it for half price, or whatever it is, some kind of reward, a t-shirt if it's $5, something, doesn't matter. That's the reward. Some of them charge fees, some of them don't charge fees. Kickstarter says you have to raise all the money that you say you're going to. I made a mistake with the Kickstarter program, that I put the amount of money, $20,000 was too high. And we only brought in 14,000. Well, 14,000 would have been great. It would have really helped the project, but because I'd never done that before, this is like 7 years ago, 8 years ago, I learned, set it low, and then you'll be fine. And finally, SomoLend does lending, and endurance lending. They're all about debt. So there's various equity rules that each one of them have. You're going to have this, what I'm showing up here, so you can go back and look at it. It's a little more detail than I want to get into. Finally, in this whole idea of creative funding, as you get into creating this opportunity, you've just got to think differently. You've got to think of interesting ways. We had some investors that wanted to come in and they weren't sure, and I asked them, I said, what do you want? I said, well, we want controlling interest. I said, it doesn't work that way. Why do you want controlling interest? Well, because I don't want you guys taking profits before I get paid. And I thought, well, that's reasonable. I said, how about this? How about, the amount we're asking for is you're putting up this much money for 10% ownership. How about if we do this? How about if you have majority status on income so that you get 100% of the money coming in, the profit coming in, until your $100,000 is paid for. And then you drop back to 10%. That's great. So I took all of the risk, that's not completely true, but I reversed the risk. So I would never gonna make a dime until he made money. And then he felt very, very comfortable about it. So as you're going through, you just gotta be thinking creatively, and that's one of the things I don't like about the selling, is it doesn't give you a chance to ask people questions. What do you think? How do they feel? Where you're going? Where are you? And make it so easy to say no, and then you get a good discussion go. And then your creative mind can kind of figure it out. I think that we will save this for another discussion, because we've talked about it. So those are basically the 10 rules for getting in and starting fundraising. So take a look through this, go ahead and go back over this PowerPoint a number of times, and it'll kind of all coalesce, and that'll give you the idea. Okay? Any questions? All right, if you do have questions, what do?
Ask.
Email me, ask me. Thank you very much.